Ever wondered what happens when a company finds itself in a truly tight spot financially, unable to meet its debt obligations? Or perhaps, on the flip side, when a large, seemingly rock-solid corporation decides to pay off its massive bonds years, even decades, before they're actually due? Today, we're pulling back the curtain on the often misunderstood yet incredibly vital world of troubled debt restructuring and debt extinguishment. Now, these terms might sound like they're plucked straight from an advanced accounting seminar or maybe, some high-stakes corporate boardroom drama. But trust us, understanding these concepts isn't just for accountants. It unlocks a powerful lens through which to view a company's financial health, its strategic resilience, and how it truly navigates both calm and turbulent waters. We've meticulously combed through some robust resource material, and our mission here, as always, is to unpack it all for you, making every complex nuance, well, easy to grasp.
Indeed, it's about looking beyond the surface level numbers. We'll be examining these situations from both crucial perspectives: the company that owes the money, grappling with financial difficulty, and the creditor, the lender, striving to recover their investment. You quickly see that there are very precise, often counterintuitive rules governing how these scenarios are handled. And these rules can have a profound and lasting impact on financial statements, influencing everything from reported profits to a company's perceived stability.
Okay, let's dive right into the first major concept. Troubled debt restructuring, or as it's often abbreviated, TDR. Imagine a hypothetical company, let's call them Horizon Innovations, a promising tech firm that suddenly hit a rough patch. Maybe a major product launch didn't quite meet expectations, or a critical supply chain got disrupted. Whatever the reason, Horizon is now struggling to make its loan payments on time. A troubled debt restructuring, in essence, it's kind of a lifeline. It's a situation where a creditor, the lender like a bank, grants concessions to a debtor, our Horizon Innovations, specifically because that debtor is experiencing genuine financial difficulty. It's absolutely crucial to understand the why behind these concessions, right? This isn't just about a bank being flexible or offering some standard loan modification. The research we've explored makes it crystal clear. These concessions would not happen under normal, healthy business circumstances. The creditor isn't extending a helping hand purely out of generosity. Their objective is intensely pragmatic. They're trying to maximize the recovery of their initial investment. Faced with the stark choice of potentially losing everything if Horizon Innovations defaults or files for bankruptcy, they opt to get something back, even if it's less than originally agreed. It's a calculated gamble, really, to avert a total loss.
Exactly. It's a gamble based on recovery.
So what do these concessions actually look like in practice? Our source material outlines several common forms. We're talking about things like a reduced interest rate, making Horizon's ongoing payments lighter, more manageable. Or the creditor might agree to an extended maturity date, giving Horizon significantly more time to pay back the principal loan amount. In more severe cases, you might see a reduction of the face amount of the debt itself. The principal amount owed is literally lowered, or even a reduction of accrued interest that has built up, essentially forgiving past unpaid interest. These aren't just casual adjustments. They're often the result of intense, complex negotiations, sometimes even involving legal proceedings, all designed to salvage financial value, hopefully for both parties.
What's truly fascinating here is how this plays out as a strategic, albeit difficult, move for both sides. For the struggling debtor, like Horizon Innovations, a TDR offers a vital chance to breathe, to avoid bankruptcy, and to restructure their financial obligations into something manageable. It's a critical second chance. For the creditor, as you pointed out, it's far from an act of charity. It's a sophisticated risk management decision. They're making a concession today to avoid a potentially larger loss tomorrow. This whole scenario, while challenging, necessitates very specific and often intricate accounting treatments, which leads us to the important question: how exactly do both sides, the debtor seeking relief and the creditor seeking recovery, account for these significant financial changes on their books? And what does that tell us about their true financial picture?
Good question. Let's start by looking at the debtor, the company that's, well, in a bit of a pickle, like our Horizon Innovations. How do they record these changes on their financial statements? Our deep dive into the material reveals a few distinct scenarios, really depending on the nature of the concession. First up, a debtor might transfer assets to settle the debt. Imagine Horizon Innovations, instead of trying to scrounge up cash they don't have, offers a piece of property they own or maybe some specialized manufacturing equipment directly to the creditor as full or partial payment for the loan. When this happens, the accounting can get quite interesting because the source material specifies that two distinct gains or losses often need to be recognized. The first is a gain or loss on disposition of asset. This is essentially what Horizon Innovations would recognize if they had just, sold that asset in the open market. It's the difference between the asset's book value, what Horizon recorded it for on their balance sheet, typically its historical cost less any accumulated depreciation, and its fair value at the time of the transfer. This gain or loss immediately hits the income statement for the period. It reflects the true economic value of that asset right at that moment. Then the second one is a gain on restructuring. This gain arises from the debt itself. It's the excess of the carrying amount of the payable, that's the total amount Horizon owed, including the original principal plus any accrued interest or maybe unamortized premiums, basically the net book value of the debt on their ledger over the fair value of the assets given up. This gain is also recognized on the income statement, so you can see how a single transaction, just transferring an asset, can result in two distinct financial impacts hitting the income statement. It highlights the, multi-layered nature of these events.
Let's make this more concrete. We can use an example from our source, the Hull Company scenario. Okay, so imagine Hull Company owed Apex, their creditor, a substantial $500,000 note, plus an additional $60,000 in accrued unpaid interest. That brings their total debt obligation to $560,000. Hull was struggling, right? So Apex agreed to settle this entire $560,000 debt by taking a specific tract of land that Hull owned. Now, this land had a fair market value of $450,000 at the time of transfer, and crucially, Hull had originally acquired this land for only $360,000. So for Hull Company, let's break down the two impacts. First, the gain on disposal of land. Hull's land was on their books at $350,000, but its fair value at the time of transfer was $450,000. The difference, $450,000 minus $360,000, results in a $90,000 gain on disposal of land. This reflects the economic appreciation of the land itself. Makes sense. Second, the gain on restructuring. Hull owed Apex $560,000. They settled this by giving up an asset, the land that had a fair value of $450,000. The difference between what they owed, $560,000, and the value of what they gave up, $450,000, is a $110,000 gain on restructuring.
So by combining these two, Hull Company effectively recognizes a total gain of $200,000 from this single transaction. From an accounting perspective, Hull would effectively clear the $560,000 debt from their books, remove the land at its original cost, and then report those two separate gains in their income statement. It's definitely a financial relief for the debtor, even though it stems from a difficult situation.
Right, a $200,000 boost to income, even though they're in trouble. Interesting. Now, instead of transferring physical assets, what if the debtor gives up a piece of their own company and equity interest to settle the debt? This isn't uncommon, especially for struggling startups or companies where creditors might see some long-term potential, maybe. For example, Horizon Innovations might issue new shares of its common stock directly to its creditor, Apex, in exchange for wiping out the debt. In this scenario, the source material specifies a slightly simpler calculation for the debtor. The difference between the carrying amount of the payable and the fair value of the equity interest transferred is recognized directly as a gain on restructuring of debt under U.S. GAAP. It's simpler because you're not disposing of an existing asset that had its own historical cost. You're just issuing new equity. Let's use the Hull Company example again, but this time, imagine Hull gives Apex an equity interest, say new shares, instead of land. The total debt remains the same, $560,000. Hull gives Apex common stock with a fair value of $450,000. So the calculation for the gain on restructuring is pretty straightforward. The carrying amount of the payable, $560,000, minus the fair value of the equity given up, $450,000, equals a $110,000 gain on restructuring. For Hull, this means they would effectively remove the $560,000 debt from their books. They would then record the issuance of the new stock at its fair value, likely impacting both common stock and additional paid-in capital accounts. And crucially, they book that $110,000 gain directly to their income statement. It's a clean way to reduce a significant liability by exchanging a piece of future ownership for present relief.
And here's a crucial point, a real passkey from our sources that ties these two together. For both asset and equity transfers in a troubled debt restructuring, once that transfer physically happens, the debt is considered extinguished. That's a powerful concept. When debt is extinguished, it means that specific liability is completely wiped off the debtor's balance sheet. It's gone. It's a clean slate for that particular obligation. For the debtor, this is a major financial event. It removes the liability, reduces their overall debt burden, and can significantly improve critical financial metrics like their debt-to-equity ratios. This is often seen positively by investors and analysts, signaling a stronger, less leveraged financial position moving forward.
Okay, extinguished. That's clear for asset and equity transfers. But what if no assets or equity actually change hands? What if the debtor and creditor simply agree to change the original terms of the loan? This is called a modification of terms. Think about Horizon Innovations again. Instead of giving up land or equity, maybe Apex just agrees to give them a break, a lower interest rate, or an extension of the due date for the loan's principal. Our sources tell us that this type of restructuring often involves what's called prospective accounting. This means the debtor generally doesn't go back and change the original carrying amount of the debt unless something very specific occurs, which is if the existing carrying amount of the debt, that $560,000 Hull owed, actually exceeds the total future cash payments specified by the new modified terms. And this is a key distinction, another pass-key moment. Under a modification of terms, the debt has not been extinguished. The terms have merely been adjusted to make it easier for the debtor to meet their obligations. The debt is still very much present on the balance sheet, it just has different conditions.
Right, it's still there, just different rules.
Exactly. So, how do they figure out these total future cash payments? It's simply the principal amount plus any accrued interest that continues to be payable under the new terms. If, for instance, some accrued interest was forgiven as part of the deal, that forgiven amount wouldn't be included in this future total. And how is interest expense computed after the modification? Our sources say it's done using a constant effective rate method where a new effective interest rate is calculated. This new rate effectively discounts the carrying amount of the debt down to the present value of those new future cash payments. It's all about finding the rate that makes the numbers align going forward under the adjusted terms. Now, here's where a gain can still emerge even without assets or equity being transferred. This is the gain scenario. If the total undiscounted future cash payments, meaning simply adding up all the principal and interest payments that Horizon Innovations will make under the new terms, no discounting involved here, are less than the current carrying amount of the debt, then the debtor gets to recognize a gain. Horizon Innovations would reduce the carrying amount of the debt on their books and recognize the difference as a gain on restructuring. What's truly noteworthy here and kind of counterintuitive is that once this reduction occurs and the gain is recognized, all subsequent cash payments made by Horizon Innovations simply reduce the carrying amount of the debt. And crucially, no further interest expense is recognized after the restructure date. The debt is essentially being paid down directly without additional interest charge and hitting the income statement because the original interest component that would have generated that expense has effectively been written off as part of the gain.
That's a really significant point. No future interest expense.
Yeah, but there's also a no gain scenario. This applies if the future payments are indeterminate, meaning uncertain, or if there's a possibility that the total future payments might actually exceed the debt's current carrying amount. In these situations, the debtor, playing it conservatively, recognizes no immediate gain and they don't adjust the carrying value of the note downward. The debtor assumes that any contingent future payments will indeed be made, at least to the extent necessary to avoid recognizing an immediate gain. It's a cautious accounting approach, basically, designed to prevent reporting a gain that might not truly materialize down the road.
Let's illustrate that gain scenario with another look at Hull Company. Their initial debt was $560,000. Remember, $500 K note, $60K accrued interest. This time, Apex agrees to a modification of terms. The $60,000 in accrued interest is completely forgiven, wiped away. The interest rate on the $500,000 principal note is drastically lowered to a mere 3%, and the maturity date is extended further out to December 31, year 5. So first step, what are the total future cash payments Hull will make under these new terms? They will still pay the $500,000 face amount of the note when it matures, plus they'll pay interest at the new 3% rate for 2 more years. That's $15,000 in year 4, $500,000 times 3%, and another $15,000 in year 5. So adding it all up, the total future cash payments amount to $500,000 principal, plus $15,000 interest, plus $15,000 interest, which totals $530,000. Now for the gain on restructuring. Hull's carrying amount of the payable was originally $506,000. The total undiscounted future cash payments under the new terms are only $530,000. The difference, $560,000 and minus $530,000, is a $30,000 gain on restructuring of debt for Hull.
From an accounting perspective, Hull would effectively remove the $60,000 in accrued interest payable from their books, record the $30,000 gain in income, and then adjust the original $500,000 note payable downward to a new carrying amount of $530,000. This newly adjusted note then represents the total remaining amount Hull needs to pay. And the crucial takeaway, as you mentioned, is that all subsequent cash payments, both the principal and the new lower $15,000 interest amounts, will directly reduce this new $530,000 note payable balance. and Hull recognizes no further interest expense after this restructuring date. It significantly eases their financial burden, that's for sure.
Okay, that makes sense. It's a gain, but the debt isn't extinguished, it's just reduced. Sometimes, though, these troubled debt restructurings aren't just one type of concession. They involve a combination of types. A restructuring might include both the transfer of an asset and a modification of the remaining debt's terms. How do they handle that complexity?
Right, a hybrid situation. Our source material provides clear guidance on the order of operations here. The fair value of any asset or equity transferred is used first to reduce the carrying amount of the payable. You deal with the transfer first. Any gain or loss on that asset transfer itself, remember the difference between its fair value and its book value, is recognized immediately. But here's the critical sequencing point. No additional restructuring gain can be recognized from the modification of terms part unless the carrying amount of the payable still exceeds the total future cash payments after that initial asset or equity transfer has been fully accounted for. It's a step-by-step process to ensure accuracy. You reduce the debt by the fair value of the asset equity first, recognize gain loss on the asset, then compare the remaining debt carrying amount to the future payments under the modified terms.
Got it. Sequence matters. So after all this accounting wizardry, what does this all mean for a company's financial statements? Where do all these gains on debt restructuring, whether from asset transfers, equity transfers, or modifications of terms, actually end up?
Good question. Our sources clearly state that all gains on debt restructuring are aggregated together and included in net income for the period. They're typically classified within the continuing operations section of the income statement. This means they directly boost the company's reported profitability for that period. It provides a financial uplift, even if it's a consequence of prior financial difficulty. It can sometimes even make a struggling company appear, momentarily more profitable than its underlying operations might suggest. So it's definitely a number analysts scrutinize carefully.
Okay, that covers the debtor side pretty thoroughly. Now, let's flip the coin. What about the creditor, the lender, like Apex in our examples? They're also in a troubled situation, but from the opposite angle. They're facing a potential loss on the money they've loaned out.
Absolutely. Their perspective is quite different. First, there's the recognition of impairment. A loan is considered impaired if it's probable, meaning highly likely based on current information and events, that the creditor won't collect all amounts due under the original contract. That includes both principal and interest when they were originally expected. And the source material explicitly states that any loan restructured in a troubled debt restructuring is by definition an impaired loan. That part's pretty straightforward. If you have to grant concessions because the borrower is in trouble, the loan is impaired.
Okay, so it's impaired. How do they actually measure how impaired the loan is? What are the financial consequences for the creditor?
It depends on how the restructuring happens, mirroring a debtor's side but with opposite results. If the creditor receives assets or equity as full settlement, like Apex receiving that land from Hull, they account for these received assets or equity at their fair value at the time of the restructuring. The excess of the recorded receivable, the original amount owed to them by the debtor, including principal and accrued interest, over the fair value of the asset or equity they received, is recognized as a loss for the creditor. They essentially treat these assets as if they had purchased them at their fair value to settle the debt.
Okay, let's revisit that Apex example. Apex was owed $560,000 by Hull Company, $500 K note plus $60K interest. Apex received land worth $450,000. So the amount Apex was owed, $560,000, minus the fair value of the land they received, $450,000, results in a $110,000 loss for Apex, right?
Exactly. That $110,000 difference is a direct hit to Apex's bottom line. From an accounting standpoint, Apex would record the land asset at its fair value, $450K, remove the original note and interest receivable, $560K total, and then recognize that $110,000 difference, usually by increasing their allowance for credit losses, which then flows through to bad debt expense on their income statement. This loss directly impacts their profitability, reflecting the economic hit they've taken on that specific loan.
Okay, that's for asset or equity transfers. What about when it's a modification of terms, like in the third Hull Company example where the interest rate was lowered and maturity extended?
Right. In that case, the impairment is typically measured as part of the creditor's broader assessment of their overall credit losses for their entire loan portfolio. Any losses specifically from a troubled debt restructuring of this nature are incorporated into the creditor's overall allowance for credit losses. Our sources clarify that if the creditor uses a discounted cash flow DCF approach to measure this impairment, which is common, they must use the post-restructuring effective interest rate as the discount rate for those expected future cash flows, not the original rate. The impairment amount itself is ultimately recorded by debiting bad debt expense and crediting allowance for credit losses. Again, this directly reduces the creditor's reported income for the period, reflecting the diminished economic value of their loan asset due to the concessions granted.
So let's follow through with Apex, the creditor, in that modification of terms scenario. Hull's original debt was $560,000. Apex forgave the accrued interest, lowered the rate to 3%, extended maturity. How does Apex calculate their loss?
Okay. Apex needs to compare the pre-restructure carrying amount, $560,000, to the present value of the restructured cash flows they now expect to receive under the new terms. The restructured cash flows for Apex are the $500,000 principal due in 2 years, and those 2 annual interest payments of $15,000 each, 500 TA by 3%. Apex then discounts these new lower cash flows back to their present value. Our source material indicates they'd use a post-restructuring effective interest rate. Let's say I calculate out at 3.50% for this example. Using that 3.50% rate, the present value of the $500,000 principal due in 2 years is calculated as approximately $466,755, and the present value of the two $15,000 interest payments and annuity, discounted at 3.50%, is roughly $28,500. Adding those present values up, the total present value of restructured cash flows for Apex is $466,755 plus $28,500, which equals $495,255. So the creditor's loss is the difference. Pre-restructure carrying amount, $560,000 minus the present value of restructured cash flows, $495,255. That equals a $64,745 loss for Apex. This loss is recognized by increasing their bad debt expense and their allowance for credit losses.
Wow. So in the same modification transaction, Hull recognized a $30,000 gain, and Apex recognized a $64,745 loss.
Exactly. It truly highlights the stark contrast in perspective. While the debtor, Hull, recognized a gain from having debt forgiven or terms eased, the creditor, Apex, recognized an impairment loss because they are simply not recovering the full original amount they expected, especially on a present value basis. It's two sides of the same very complex financial coin. For the debtor, it's a chance to reset, a lifeline. For the creditor, it's a recognition of reduced future economic benefit, reflecting the real financial loss from that struggling loan. It's a dynamic interplay, really, showing how these events have nuanced and often opposing impacts.
That's a powerful point, and it moves us nicely into the broader concept of extinguishment of debt. We've talked about debt restructuring in troubled situations where the debt might be modified or even partially extinguished if assets or equity are transferred. But what about the wider concept of debt extinguishment? When does a liability truly, definitively disappear from a company's financial statements beyond just being modified or partially settled?
Good question. A liability isn't truly removed from the financial statements until it's officially extinguished. Our source material clearly defines two fundamental pathways for this to happen. First, the debtor actually pays the creditor and is fully relieved of the obligation. That's the most straightforward and common method, obviously. Pay up, it's gone. Second, the debtor is legally released from being the primary obligor on the debt. This can happen either through a formal judicial process, like a bankruptcy court ruling, or directly by the creditor forgiving the debt without necessarily receiving full payment. These two conditions, payment or legal release, are the absolute prerequisites for a liability to be fully derecognized from a company's books.
Okay, let's consider the most straightforward way, simply paying it off. But even here, you said there are nuances, especially when we're talking about bonds. First, there's bond extinguishment at maturity. This is the ideal, clean scenario. When a bond reaches its maturity date, it's typically paid off at its face value. By this point, any initial discount or premium on the bond would have been fully amortized over the life of the bond, meaning its value has been gradually adjusted over time on the balance sheet. So its carrying value usually equals its face amount right at maturity. In this clean scenario, when the company writes the check for the face amount, no gain or loss is recorded. It's a straightforward payoff, like closing a simple loan. The journal entry is simple: debit bonds payable, credit cash. Done. But what if a company decides to pay off its bonds before they're actually due? This is where it gets much more interesting, and often a gain or loss is recorded. The key here is that the gain or loss is the difference between the carrying value of the bond at that early date, which is its face value, adjusted for any remaining unamortized discount or premium, and unamortized issuance costs, and the actual cash paid to extinguish it. This cash paid is also referred to as the reacquisition price. It's a strategic choice, and the financial outcome can be significant.
This immediately raises a very important question. Why on earth would a company pay off a bond early, especially if it means potentially booking a loss? Well, it often signals sophisticated strategic financial management. It's usually not done lightly. For example, imagine a company issued bonds years ago when market interest rates were high, maybe 8 or 9%. If current market rates have since dropped significantly, say down to 4%, the company might choose to retire that existing expensive high-interest debt early. They might then immediately issue new debt at a much lower prevailing rate. This process, known as refinancing, can save them potentially millions, even billions, depending on the scale, in interest expenses over the long run, even if it means taking a short-term accounting loss on the early extinguishment of the old bonds. Alternatively, maybe they're flush with cash from operations and want to reduce their overall debt burden to improve their financial ratios like debt to equity, perhaps to make themselves look more attractive for an acquisition, or simply to reduce their financial risk profile going forward. It's a calculated trade-off, usually, between an immediate accounting impact and a perceived significant long-term strategic benefit.
Okay, that makes sense. Strategic moves. Now, the other key way debt can be extinguished is if the debtor is legally released from being the primary obligor. This could happen through a formal judicial process, like a bankruptcy court decision, where debt is restructured and portions are outright forgiven, or directly by the creditor forgiving the debt. It represents a complete removal of the legal obligation. And this connects directly back to our first major topic, TDR. A troubled debt restructuring would indeed result in the extinguishment of debt, but only if the debt were explicitly forgiven by the creditor as a result of a direct transfer of assets or an equity interest. Remember, that's what happened with Hull Company giving Apex land or equity. Those specific debts were legally extinguished, wiped clean.
Exactly, and this reinforces that critical distinction we made earlier. A modification of terms in a TDR, like when Apex just changed Hull's interest rate and maturity date, is not an extinguishment. The debt is still there on the books, just with new conditions. The legal obligation to pay remains. It's merely been altered. It's not gone.
Right, not extinguished. Good distinction. Now, there's a fascinating term in our sources called in substance defeasance. This sounds like it might extinguish debt, but you're saying it actually doesn't. What's the deal with that, and why isn't it considered a true extinguishment?
In substance defeasance. It's an interesting financial maneuver, for sure. It's where a company essentially sets aside assets to cover specific debt payments. They purchase securities, usually very low-risk ones like U.S. government bonds, and place them into an irrevocable trust. They then essentially pledge these securities within the trust, specifically to cover the future principal and interest payments on a particular long-term debt obligation they have. So in essence, they're setting aside money, almost like a dedicated locked piggy bank, specifically to pay off that debt in the future, managed by a trustee. However, the critical reason why this is not considered a true extinguishment, according to current U.S. GAAP accounting standards, is that the company remains the primary obligor while the debt is still outstanding. Even though they effectively ring-fenced funds and made an arrangement for the debt to be paid by an independent third party, the trust, in the future, the ultimate legal responsibility to pay still rests firmly with the company. If, for some unforeseen reason, the trust fails, or the securities within it don't perform as expected and there's a shortfall, the company is still legally on the hook for that debt. The creditor can still come after the original company. Therefore, because that legal obligation isn't fully removed, the debt legally remains on their balance sheet and it is not considered extinguished for accounting purposes. It's more of a risk mitigation strategy or way to manage cash flows, not a liability elimination event.
Okay, that's clear. The company is still ultimately responsible. So back to early extinguishment, where the debt is actually removed. If a company decides to pay off bonds early, how do they calculate the precise gain or loss that hits their income statement? You mentioned it's more nuanced than just comparing face value to cash paid.
You're right, it's not just face value versus cash. Getting it accurate is crucial for financial reporting. When a company chooses to reacquire its own bonds before maturity buy them back, they must factor in several components to calculate the gain or loss properly. They need to consider any related unamortized bond issuance costs, those upfront costs of issuing the bond, like legal and printing fees, that haven't been fully expensed yet over the bond's life. They also need to account for any related unamortized discount or premium that's still sitting on the books related to that specific bond issue. And finally, of course, the actual cash paid to buy the bonds back, which we call the reacquisition price or reacquisition proceeds. The core calculation for the gain or loss on extinguishment of debt is quite precise. It's the difference between the reacquisition price, what the company actually paid in cash or fair value of other assets, to buy the bonds back, and the net carrying amount of the bond on the balance sheet at the exact date of extinguishment. This resulting gain or loss is then recognized immediately in income, typically as part of income from continuing operations, reported gross of any tax effects. It's an immediate reflection of the financial impact of that strategic decision to retire the debt early. Let's define those two key terms more clearly, just to be sure. The reacquisition price is usually straightforward. It's the amount paid. Often it's expressed as a percentage of the bond's face value. So if a company has a $1 million face value bond and reacquires it at, say, 102%, the reacquisition price is $1 million multiplied by 1.02, which equals $1,020,000. That's the cash outflow. The net carrying amount of the bond is its precise book value at that exact moment on the balance sheet. This is calculated as the face value of the bond, plus any unamortized premium that still exists, because the premium increases the bond's carrying value above face value, or minus any unamortized discount, because discount reduces the carrying value below face value, and also minus any remaining unamortized bond issuance costs. Those costs are treated like a reduction to the carrying amount, similar to a discount. All these adjustments ensure that the bond's true value on the balance sheet is precisely reflected right before it's removed. The goal is to make an accurate comparison between the cash the company paid to remove the debt versus its current recorded value on their books.
Okay, that's much clearer. Let's walk through an example from the sources to solidify this calculation. Let's say it's a loss scenario first. Imagine a company issued $5,000 in bonds, maybe due in 5 years. They initially sold these bonds at a discount, receiving only $926,399 in cash, and they also incurred $20,000 in bond issuance costs at that time. Now, 2 years later, maybe on January 1st, year 3, for strategic reasons, they decide to redeem the entire bond issue early. They buy them back at 101% of the face value and cancel them. At this specific point in time, the remaining unamortized discount and the remaining unamortized bond issuance costs still totaled $62,792 combined. So first, we need the reacquisition price. The bonds have a face value of $1 million, and they're being redeemed at 101%. So $1,000 multiplied by 1.01 means the company paid $1,010,000 in cash to buy back these bonds. Next, we calculate the bond carrying value at that moment. The face value is $1,000. Since the bonds were issued at a discount and had issuance costs, we subtract the total remaining unamortized discount costs, which the example gives us $62,792. So $1 million minus $62,792 results in a net carrying value of $937,208. This is what the debt was worth on their books just before extinguishment. Finally, to find the gain or loss, we compare these two figures, the reacquisition price minus the net carrying amount. So $1,010,000, what they paid, minus $937,208, what it was worth on the books, equals $72,792. Since the price paid is higher than the carrying amount, it's a loss and extinguishment of $72,792. This loss hits their income statement that period. The journal entry would basically involve removing the bonds payable, $1 a face, removing the related unamortized discount costs, $62,792, effectively increasing the debit needed, crediting cash, $1 mez, and the balancing figure is the debit to loss and extinguishment, $72,792.
Perfect. Now let's consider the opposite scenario, a gain on extinguishment. Suppose a different company issued $1 million in bonds, but this time at a premium, receiving $1,081,109 in cash initially. This means they got more than face value, likely because the interest rate offered on the bond was attractive compared to market rates at the time of issuance. 2 years later, maybe market conditions have changed, interest rates have gone up perhaps. On January 1, year 3, they decide to redeem the entire issue early, but this time they only have to pay 96% of the face value, 96 cents on the dollar, to buy them back and cancel them. At this specific time, the unamortized premium still remaining on the books totaled $52,421. Okay, first, calculate the reacquisition price. $1 million face value multiplied by 96% equals $960,000. This is the cash paid by the company to buy back the bonds, much less than face value this time. Next, the bond carrying value. The face value is $1 million. This time we add the unamortized premium of $52,421 because a premium increases the bond's carrying value above face. So $1 million plus $52,421 gives us a net carrying value of $1,052,421. This is a bond's higher value on the books just before extinguishment. Now for the gain or loss. Reacquisition price, $960,000 minus net carrying value, $1,052,421. That equals negative $92,421. A negative result here indicates a gain on extinguishment of $92,421. The company effectively bought back the debt for significantly less than its recorded value on the books. This gain directly boosts their income statement for the period. The journal entry would involve debiting bonds payable, $1 as face, debiting the related premium on bonds payable, $52,421 to remove it, crediting cash, $960K, and the balancing figure is the credited gain on extinguishment, $92,421. This often happens, as I said, when market interest rates have risen since the bonds were issued, making these older, lower coupon bonds less attractive in the market, allowing the company to repurchase them at a discount to their carrying value.
So it really cuts both ways. Whether a company pays off debt early, they could realize either a gain or a loss, depending entirely on the original issuance terms, discount or premium, how much of that has been amortized over time, and critically, the reacquisition price they pay compared to the bond's precise carrying value at that moment. It's truly a complex dance of numbers reflecting very deliberate strategic financial decisions and, of course, the prevailing market conditions at the time of extinguishment. It's a powerful tool in a company's financial management arsenal, definitely. So, wrapping this all up, what does all of this mean for you, whether you're a curious investor, a business analyst, or maybe just someone trying to make better sense of the corporate world?
Understanding troubled debt restructuring and debt extinguishment isn't just about parsing, obscure accounting entries. It gives you a much clearer, more nuanced picture of a company's financial health, its strategic decision-making, and its resilience, especially in the face of economic challenges.
Exactly. It profoundly underscores the dynamic nature of corporate finance and how companies continually manage their obligations, often in really innovative ways. It highlights that debt isn't always just this static liability that simply sits there on the balance sheet until maturity. It can be actively and strategically managed, it can be renegotiated, and it can even be dissolved in ways that profoundly impact a company's financial standing and, importantly, its future growth potential. Observing these types of transactions, TDRs, early extinguishments provide significant insights into a company's risk profile, maybe its management's proactive decision-making abilities, and sometimes even its long-term vision or pressures.
From struggling debtors getting a crucial new lease on life through carefully negotiated concessions, to financially healthy companies making these calculated strategic moves to retire bonds early and optimize their balance sheets. The world of corporate debt is anything but static. We've explored the ins and outs today, from assets and equity changing hands in troubled times to the simple modification of terms, and then the broader concept of extinguishment, both planned and strategic. And crucially, how all these complex scenarios are meticulously recorded on financial statements, impacting everything from profitability and leverage ratios to how a company is perceived by the market.
Which brings us to a final, perhaps thought-provoking question for you, the listener, to consider. How might a deeper understanding of these intricate debt management strategies, restructuring, extinguishment, refinancing, influence your perception of a company's stability, or its long-term growth prospects, or maybe even its ethical approach to its financial obligations? When you encounter news of a significant restructuring or an early debt payoff in the financial press, think about what these actions truly signal about the company's financial health and its strategic direction, really looking beyond just the immediate headline numbers.
Great question to ponder. Keep diving deep, everyone, and we'll catch you in the next one.